It starts with $500. Not a dramatic amount, not the kind of money that changes anything on its own. Just $500 sitting in a savings account, earning 0.3% annually, which is the financial equivalent of leaving your money in a drawer and occasionally blowing dust off it. You are 23 years old. You read one book about how markets work, how companies grow, how patience compounds, how the person who plants a tree they will never sit under is doing something the person waiting for shade will never understand. You put the $500 into your first stock, a consumer goods company. Boring, predictable, the kind of company that makes things people buy regardless of whether the economy is expanding or contracting. You do not tell anyone. You watch the price every day for 3 weeks. Then you stop watching. Something the book said, you remembered it on a Tuesday. The stock doesn't know you own it. Only you know you own it. The watching changes nothing except you. You stop watching. You start learning instead. Level 1, the curious investor, $500. You spend the next 2 years reading everything: annual reports, earnings calls, industry analyses, the footnotes of financial statements that most people skip because the footnotes are where the honest information lives. You learn that a company's story and a company's numbers are 2 different documents. The story is what management presents on a slide. The numbers are what the business actually did when nobody was crafting the narrative. You learn to read the numbers. Your $500 becomes $840 in 18 months, not because you did anything dramatic, because the company you chose was genuinely good and you left it alone long enough for that goodness to appear in the price. You add $200 a month from your salary. You are building something. You do not know yet how large it will get, or what it will cost you, or where the story turns. Level 2, the focused investor, $47,000. 4 years in, you own 7 companies, not 7 industries, not 7 sectors, 7 specific businesses you understand well enough to explain in 1 sentence each. Your portfolio is $47,000. You bought a small technology company at $12 per share that is now trading at $31. You bought a regional bank that most people ignored because the name wasn't exciting and the story wasn't compelling, but the return on equity was consistently 18%, and the management team had owned their own shares for 20 years without selling a single one. You are 27 years old. You make $68,000 a year. You live modestly, not as performance, not as discipline for its own sake, but because the things you find genuinely interesting, the annual reports, the earnings calls, the slow pleasure of watching a thesis play out over 3 years, cost almost nothing. You are, without trying to be, exactly the kind of investor the books described. The patient kind, the kind that compounds. Level 3, the convicted investor, $340,000. 7 years in, you made 2 significant decisions that separated your portfolio from the version of itself that would have existed if you'd been slightly less patient. The first was not selling the technology company at $31 when everyone around you said it was overvalued. It is now at $89. The second was buying more of the regional bank during a quarter when the broader market fell 22%, and your colleagues described it as terrifying. You described it as a sale. Your portfolio is $340,000. You are 30 years old. You have conviction now, not the arrogant kind that ignores evidence, the earned kind. The kind that comes from having been right for the right reasons enough times that the methodology has been tested rather than assumed. People at work ask you what to buy. You tell them you don't know what they should buy. You know what you own and why. Those are different things. Level 4, the compounding investor,
$1.2 million. 11 years in, the portfolio crossed $1 million on a Wednesday afternoon without ceremony. You were in a meeting about quarterly targets when the notification arrived on your phone. You looked at it, you put the phone away, and you continued the meeting. This is the part nobody tells you about wealth building. The number crossing a threshold feels less like a rival and more like confirmation. Confirmation that the methodology works, that the patience was not naivety, that the reading and the waiting and the not selling when everyone said sell were not stubbornness but strategy. Your portfolio is $1.2 million. You are 34 years old. You contribute $3,000 a month. You own 11 companies. 3 of them you have held for more than 7 years. One of them, the regional bank, you have held for 9. You think you understand this game completely. Then comes the letter. Not an email, a physical letter from the regional bank. You open it expecting the quarterly dividend notice. It is not the quarterly dividend notice. It is an acquisition announcement. A larger bank, a national institution with 14 million customers and a brand you have seen on every high street in America, has agreed to acquire the regional bank you have held for 9 years at a price of $47 per share. Your average cost basis is $11. You do 47 minus 11 in your head before the letter has left your hand. $36 per share gain. You own 4,200 shares. That is a $151,200 profit. You sit down. You do the tax calculation next because you are the kind of investor who always does the tax calculation. Long-term capital gains, manageable. The after-tax profit is still $128,000. You should be celebrating. You are not celebrating because the letter says something else in the 3rd paragraph, something you read once and then read again and then read a 3rd time the way people read things that are true and inconvenient. The acquisition price represents a 31% premium to the current market price, which means the current market price was already pricing in some probability of an acquisition, which means the market knew something before the letter, which means you did not know something the market knew. You have spent 11 years believing that patience and research and conviction were the edge, and they were. They absolutely were. But the edge had a ceiling, and the ceiling was information. Not illegal information, not insider trading, just the information that large institutional investors with research teams of 40 analysts and access to management that a 34-year-old with a salary and a reading habit does not have. You made $128,000 on a 9-year holding. A fund manager who received the acquisition whisper 3 months ago made the same return in 90 days. You put the letter down, you look at the 11 companies in your portfolio. You think about what you know about each one. You think about what you don't know. The don't know list is longer. It has always been longer. You just never looked at it directly until now. Here is what the letter does not take from you. The $1.2 million, still there. The methodology, still sound. The patience, still compounding. The 11 years of reading and learning and not selling when everyone said sell, still the reason the portfolio is what it is. What the letter gives you is something the books left out. Not a reason to stop, a reason to be honest about the size of the game you are playing. You are a very good investor. The very good is real and earned, and the very good has a natural ceiling. The ceiling is not failure. The ceiling is the honest outer boundary of what individual conviction without institutional access can reach. You pick up the letter again. You file it. You open the next annual report. You keep going. Because the alternative, stopping, waiting, watching, was never the point. The point was always the going.